If you watched Friday's rate breakdown video, this is the piece that moves those rates over the next 2 weeks. And here's the contrarian claim. Last week brought two pieces of good news for borrowers: disinflation and a weak jobs report. And rates still haven't meaningfully budged. I'm Robert with Open Lane Funding. Let's get into it. June's personal consumption expenditures reading, which is the Fed's preferred inflation gauge, posted its first monthly decline in 6 years. That is down 0.1%. It's pulling the year over year rate down to 3.7% from 4.1% in May. That's genuinely disinflationary, but it landed the same week as the Federal Reserve's hawkish 9-3 hold, and the markets largely shrugged off the good inflation news in favor of the hawkish descent signal. Two data points, one bullish for borrowers, one bearish, landing within 24 hours of each other. Now, then came Friday's job report, which showed that non-farm payrolls actually fell by 23,000, a significant miss against a consensus estimate of roughly 87,500 to about 91,000 jobs added. And May and June payrolls were also revised down by a combination of 103,000 jobs. Unemployment ticked down slightly to 4.1 from 4.2%. But most of that reflects people leaving the labor force. That's not real strength. A weak print like that typically pulls rate hike odds down, since it signals the labor market is actually cooling faster than the Fed's hawkish descent assumed. Now, here's why that matters. It means that the September rate decision is generally uncertain right now, that it's not a foregone conclusion in either direction, despite the headline hike odds numbers that might suggest. Now, you have to know the three data points pulling in different directions within about 10 days. You have the disinflationary PCE, a hawkish Fed descent, and a weak jobs report. Now, second quarter gross domestic product also came in at 1.5% annualized, below the 2.1 consensus. That's the 10th consecutive quarter where energy costs drag on lower income consumer spending has weighed on growth, masked by a strong artificial intelligence driven equipment investment from businesses. So in plain terms, the economy looks fine on the surface, but the underlying consumer picture and the labor market are weaker than the headline suggests. Now, here's a quick ask. If this kind of macro to mortgage translation is useful, subscribe now, follow on Facebook, because these are the indicators that actually move your loan pricing weeks before the people actually start to notice. Now, one date matters enormously right now. That's July's Consumer Price Index releasing on tomorrow, Wednesday, August 12th. It falls right before the September 15th to 16th Federal Open Market Committee meeting. Now, that next meeting where the Fed will issue the updated economic projections. Markets where pricing that meeting is at a 56.8 to about 67% cumulative odds of a hike heading into that Friday's job miss. Now, and that weak print should pull those odds down somewhat, though we won't know how much until the CPI confirms or complicates the picture. Now, here's what most people miss. Oil prices, which drove the previous rate hike, actually have cooled. West Texas Intermediate crude has moderated from a roughly about $82 per barrel. That's roughly a 5-week high in mid-July, down to the high 70s to low 80 range through early August. Now, that removes some acute upside risk to Wednesday's consumer price print, though tariff pass-through remains a wild card that could still push inflation higher. So, what should you do with this information as an investor? First, don't assume that the rate hike is locked in anymore. Friday's job miss meaningfully weakens that case, but it's still a probability, not a certainty. And Wednesday's CPI print can move that number substantially in either direction. Second, if you're deciding whether to lock in your rate now or wait, the calculus just shifted. A weaker job market combination with disinflation Fed gives the Fed more room to hold or even cut, not hike. So, which that could mean better pricing ahead of this if this trend continues. Third, keep an eye on the producer price index. That's also releasing August 13th, which feeds directly into future inflation readings. Here in Spokane and Coeur d'Alene market, this macro uncertainty is layered on top of an already cautious buyer behavior, which is part of why we're seeing flat local pricing rather than a sharper declines. Some national Sunbelt markets are experiencing right now. So, as of this report date, this is not a rate guarantee, just just current lender indications and published economic data. So if you want actual loan scenarios and deal structures behind these numbers, book a call at openlanefunding.com or call me at 208-215-9936 so that I can help you out. And until then, I'll talk to you guys tomorrow. Have a great one.